All right, next question. I know you guys like this one. In this example, these are the facts, by the way. During the first month of operations, Jay Cutler had the following transactions. April 3rd, bought 4,000 units at $4.25, that's $4.25. April 15th, bought 2,000 units at $4.50. April 25th, bought 3,000 units at $4.75. So those are all the purchases. Then we have the sales. April 10th, they sold 3,000 units. April 20th, they sold 1,000 units. But I'm not telling you what was the cost. That's what you have to figure out. So for number 2, I'm using the last in, first out inventory method. Under the last in, first out, we value the cost at the end. Last in, last out, at the ending layer. So last in, last out, we value the ending inventory at the ending layer. We value the ending inventory at the beginning layer. So let's set up this table. So this is how you should set up your table. The first column will list your date. Second column, you will have your purchases. Third column, I have a problem remembering stuff. I know there's 2 other columns. What's the third column?
Cost of goods sold. Cost of goods sold.
Yeah, that's the cost of goods sold. And the last one equals
Inventory.
the ending balance of inventory. And I'm going to abbreviate for that one. April 3rd. So let's start listing the transactions. April 3rd, they purchased 4,000 units at $4.25, right? What does that equal?
17,000.
17,000. Nothing else happened on the 3rd, so we carry that balance to the ending inventory. 4,000 times 425 equals 17,000. So that's the first layer. Second layer, April 10th, or the second activity I should say, April 10th, they purchased, or they sold 3,000 units. What is the cost?
$4.25.
Yeah, in this case, regardless of the method we use, it's still going to be the same. There's only one layer, so it's 3,000 times 425 equals 12,750. Ending layer, we have 1,000 at 425. That equals 4,250. Okay, next activity. April 15th. April 15th, they purchased 2,000 units at $4.50. That's $9,000. So now we got, how many layers do we have?
2.
So we have 1,000 at $4.25 equals 4,250. We just added another layer, 2,000 at $4.50 equals 9,000, right? So let's say we were to stop here. What would be the ending inventory? You add up these 2 numbers, right?
Mm-hmm.
That equals 13,250. We got a couple more transactions. April 20th, they sold 1,000 units. So on April 20th, they sold 1,000 units. This is last in, first out. So they sold 1,000 units. Which layer am I going to take it from?
The last layer.
The last one, the second layer, right? So it's going to be 1,000 units at $4.50. I don't have a calculator, but I think that equals 4,500, right?
Mm-hmm.
So now how many layers we have? We have 2 layers. 1,000 at $4.25. That equals 4,250. 1,000 at $4.50. That equals 4,500. if we were to stop there, what would the ending inventory be? 4,250 plus 4,500 equals 8,750. I have one more transaction. On April 25th, they bought 3,000 units at 475. So this one, we're just adding another layer. So 3,000 at 475 equals 14,250. So now we got three layers. We got 1,000 at 425, which equals 4,250. 1,000 at 450, which equals 4,500. We just added another layer. We added 3,000 at 475. Which equals 14. Now, this particular problem, I just asked you for the total cost of goods sold. So I'm asking the total for this column, right? So total cost of goods sold for this example, 12,750 plus 4,500 gives me
17,250.
17,250. What happens if I add the 1,000 at the three layers? So 1,000 at 425, 1,000 at 450, and 3,000 at 475. 23,000 even. So I got 23,000 even. So if I were to ask you for the ending inventory, that would be your answer, 23,000. Okay, I know it does take a lot of work. Number 3, using the same facts as number 2, except Jay Cutler, who I hope the Bears are going to get rid of soon, uses the first in, first out method, determine cost of goods sold. So I'm going to do the exact same schedule, and I'm going to do cost of goods sold and ending inventory. But I'm a bit lazy today. Can I just use this exact table? All right, so let's do number 3. And help me modify this particular table. So now in number 3, we're using FIFO. So under FIFO, first in, first out, the cost is valued at the beginning layer. The ending inventory is valued at the ending layer. So this layer stays the same, correct? Or this activity stays the same, right? This activity stays the same.
Yes.
This stays the same because at that point when we sold the 3,000 units, we only had one layer to deal with. So we don't have to do any further analysis. On the April 20th, there was 1,000 units that we sold. We have 2 layers. We have to figure out where am I going to take it from. So again, first in, first out, cost is valued at beginning, right? So my cost in this case would be 1,000 at 425, 4,250. So now I only have one layer, right? I took out the 1,000 at 425, so now I have 2,000 at 450, and that equals 9,000. Since the ending inventory carries over to the next activity, that it also impacts the next activity. I'm going to erase this whole thing. So for the next activity, we purchased 3,000 units at 475. So we're adding another layer. So 2,000 at 450 was 9,000. We just added another layer, the purchase of 3,000 units at 475. So 3,000 at 475 equals 14,250. So this equals 23,250, right? And that, as I said, that carries over to the ending balance of the inventory, 23,250. What is the cost of goods sold under this fact pattern?
17,000.
17,000. Now, I know I didn't give you any sales figures, but just by looking at the cost of goods sold, which one would give you a greater gross profit? First in, first out. Because cost of goods sold would be less, the gross profit is going to be higher. The net income is going to be higher. Conversely, under FIFO, if you look at the figure under LIFO, that was 17,250. Cost of goods sold is more, which means the gross profit would be less, which means the net income would be less. So again, depending on what you're trying to achieve, you have to stick with the same method for accounting purposes as you do for tax purposes and vice versa.